Interest rates are really starting to crack. In fact, they're starting to crash in several key places. China, for example, bond yields there have plunged. I mean, plunged just recently. US dollar interest rate swap spreads, they have done the same thing. Record lows there too. And you might wonder, what does the one have to do with the other? Well, as you're about to find out, they are very closely related. And not just with each other either. From European bonds to Canadians, even US treasuries, global interest rates follow China and swap spreads. That means if they're going down by a lot, then everyone else is going to follow, including central bankers. In many ways, they already are. Now, central bank rate cuts represent nothing more than central banks finally getting out of the way of these various markets. So the question to ask isn't whether the Fed will cut beyond this week or how much faster the ECB might speed up. It's how low will market rates get? And I've shown before that one of the best uses of swaps and swap spreads is to answer that very question. So we'll go over swaps and see what the latest record lows have in store for nominal interest rates in treasuries and beyond. And the thing about swap spreads is that they look at interest rate fundamentals free from central bank interference. That's why they can tell us where rates are likely to go when the Jay Powells and Christine Lagardes and Tiff Macklams of the world finally stand aside. And just like swaps had predicted, that's exactly what central bankers are doing. The faster they cut rates, the more they do that because they see the same thing as the market already had, if not entirely in the same way. And we also get that from China too, believe it or not. And after you see the data and the charts, you're going to believe it too. Chinese bonds are a snapshot of global factors and are also free from Western and even Chinese central bank interference. Swaps are fundamentals without central bankers. Chinese bonds are fundamentals without central bankers. No wonder they come to the same conclusions, even if from vastly different perspectives. And that's what makes this extraordinarily compelling and alarming, since swap spreads are plunging and Chinese bond yields are crashing. Central banks are already moving faster to the downside, and the world is inching closer to the same rate cliff that swaps and Chinese yields have already gone over. Economists and central bankers, therefore the media, consider bond markets to be an extension of central bank policies when they're nothing of the sort. The world doesn't revolve around the Fed as you're taught by the Fed. Instead, it's the black hole that's at the center of everything. And close to the very center of the black hole, maybe closest to the center of the black hole, we've got a couple of critical signals that are flashing big warnings about interest rates going down and going down by quite a lot. And that starts with China. Let's start there. Chinese bond yields have, as I said, absolutely plunged in almost historic fashion over the last several weeks. China's 10-year, for example, back on October 8th, that yielded about 2.213%. That was the recent high after the market, which proves that interest rates are fundamental. Bond market rates in China backed up, which means they went higher after the PBOC and the Politburo and the central authorities there announced their stimulus plans. Stimulus would mean, if it worked, higher growth and inflation expectations, which for a very brief moment, China's bond market said, well, we don't really believe it, but you never know, it could possibly work. So rates moved up a little bit, even though part of that stimulus package was going to be central bank rate cuts. Even as late as November 27th, the 10-year was still yielding 2.078%, which was just close to the record low. But since then, over the last several weeks, what are we talking about, 3 weeks here, the rate has absolutely plummeted by almost 37 basis points to this morning when the 10-year was yielding 1.71%. That 37 basis point drop in about 3 weeks is almost a record amount in that short of a period of time. We haven't seen anything like this since March of 2020, March 9th of 2020, April of 2015, back during Eurodollar number 3, when a lot of things were going wrong in China around the rest of the world. The record amount was up until October 14th of 2015, which should ring a whole bunch of alarm bells to longtime Eurodollar University fans and members. October 15th of 2014 was a collateral day. We saw a huge demand, buying panic in U.S. Treasuries for collateral. Here we have, before even getting to that, The 10-year Chinese government bond yield plunging by 38 basis points in a relatively short period of time. And you see it early January of 2014 as well, even back in the thick of Eurodollar number 2, October of 2011. So Chinese bond yields make big moves when we see lots of big stuff happening across the Eurodollar system. And we'll get to that correlation in just a little bit. The 2-year, which finally got to be a record low, and that's not a good sign. That one had been 1.584% on October 23rd. So that lingered around in the stimulus might work category for a little bit longer than the long end of the bond market. And then November 27th, it's down to 1.408%. And then today, 1.158%, which is not only a record low, it's very clearly a record low. And most clear of all is how quickly rates have fallen in China. But before we get into the mainstream media view on what's happening in Chinese bond market, I want to let you know that Eurodollar University, we're going to be having a Christmas sale coming up. Here's your chance to go deep into the money and macro world. And we're even launching our AI-assisted Eurodollar University, where you can search for your own information, even ask it questions about various topics and get answers from the Eurodollar perspective. And I have a huge catalog of research material to go through that's now available, been unlocked by artificial intelligence. It's part of the DDA package, which will also include a membership and daily briefing. And that's all coming up this coming weekend. And it will run through the end of the year into New Year's. So it's more of an after Christmas, New Year's, happy 2025 sale. But check out the details at our website coming up, like I said, this weekend. Now we have China's bond yields plunging, which means, according to the mainstream media, this is all about the PBOC and central banks, when China bond yields have been going down for years and years and years, and the central bank there has simply been following the market. What bonds are saying with lower yields, especially record low yields going this fast, is that stimulus didn't work. And if the last bazooka didn't work, what are the chances the next one are going to work? In fact, as I keep saying, the more the Chinese government feels it has to do, the worse you know it is. That's what the bond market has been telling us all along. They told us that the bazooka was not going to work. There was going to be no positive effect or no lingering positive effect, certainly no permanent positive effect from it, and that yields continue to go down because the situation in China, as a reflection of the rest of the world, keeps getting worse and worse. And now the Chinese government, having failed at the bazooka, have basically proven they don't know what to do. They certainly don't have a magic bullet that can fix everything. Now, just briefly before we get to the rest of the bond market interest rates around the world, what was reported over the weekend was the big three economic statistics from China. That was retail sales, industrial production, and fixed asset investment. The Chinese also issued and released their financial statistics report, as well as total social financing on the banking system and credit growth, which were even more grim than the macroeconomic data. They mentioned retail sales. Retail sales in China slipped back to a 3% year-over-year change in the month of November. It had been 4.8%, which was, in my view, a little bit dubious, and that's something I went over in the Eurodollar University daily briefing last month. So it slipped back to 3%, which was supposed to continue to accelerate if stimulus was having the effect that it was supposed to. Even fixed asset investment on an accumulated basis, that one dipped down to 3.3% year-over-year from 3.4%. Again, not a whole lot of impact from China's bazooka. Home prices. The 70-city average in China was down 5.7% year over year in November, which was a little bit better than October's minus 5.9%. But Chinese home prices, according to the 70-city average, fell another 0.5% in November alone, after falling 0.5% in October, after falling 0.7% for the 5 months before that. It's just not working out the way it was supposed to, at least according to mainstream economics. The bond market, on the other hand, continues to say, and has said all along, this was not going to work. And it's already here in December from November data, we can see that it isn't working. It sure as hell isn't working in the banking system. PBOC, People's Bank of China, already reported that, for example, household loans in the month of November, they had only increased by 270 billion. Well, that's a little bit better than October. This is not seasonally adjusted. That actually was less than the prior November of 2023. So despite rate cuts there and a whole bunch of programs that were implemented to help, especially first-time home buyers, but removing restrictions on home buying overall, not a whole lot of borrowing because Chinese banks don't want to lend. We see that in terms of total social financing. New RMB loans were 580 billion in November, which was just barely more than half of last November's 1.09 trillion. You can really see how big of trouble Chinese banks are in when you look at the year-to-date totals of new RMB loans as far as total social financing. It's down 23.7% from the same period in 2023. China's banks are in big trouble, which is one reason why, as I mentioned in a recent video, Chinese authorities might be looking at something called money finance fiscal expansion as a way to try to bypass this malfunctioning banking system, which, by the way, is malfunctioning in a big way that would be consistent with lower and lower bond yields. It doesn't necessarily suggest that China's banks are going to blow up, as I said in that video, but they are in big trouble, and so therefore is China's economy. And so you think, well, too bad for China. They got a big mess on their hands. And so government bond yields going lower, lower growth and inflation expectation, higher demand for safety and liquidity. That makes perfect sense. China's a mess. Their banking system is getting worse, not better. Great. That's China's problem. What does it have to do with everyone else? But then you see how China's bond yields closely correspond to, China's currency, CNY. And CNY, well, maybe that's about China too, but there's also other more global factors in the behavior of the China's yuan. And there's also other indications like copper to gold. There's a close relationship between Chinese bond yields and copper to gold. So now we're seeing not strictly China, but copper, you can make the argument, and even gold too, that has a lot of Chinese flavor in it. So maybe these other signals are just reflecting the same thing as China's government bond market, which is basically the internal mechanisms and their internal disruption that's going on in China. But then you look at China's bond yields against other signals and other interest rate markets, such as, well, we'll start here with Germany. Now, there is a close trade connection between Germany and China, so you expect there was some spillover here. What you see is that there's a pretty decent correlation between German yields and their Chinese counterparts. Going all the way back to 2011, really 2010, there was only some, 2011 crisis, interest rates fell in both of those places, China and Germany. There was only some small upside in Germany in 2013 compared to China. There's much more reflation there. And again, reflation is seen as interest rates rise, not fall. Falling rates are not stimulus, they're a reflection of negative fundamentals. So you get a small rise in Germany, much larger rise in China in 2013, but both are down sharply. Eurodollar number 3, 2014 through 2016, which is not a good time in China more than Germany, yet interest rates fell very sharply in Europe anyway. There was a small upside again in Germany in 2017 and 2018, globally synchronized growth, but then both are down big 2018 and 2019, but importantly, notice how Chinese yields start to fall before they get picked up in Germany. Germany is one of the first ones in the Western world to pick on what became Eurodollar number 4 anyway. Now, obviously, there's been a big divergence in the 2020s, especially in 2021 and 2022. Chinese bond yields started to go down way back in early 2021 as they were starting to get the sense that it was a fraud of a recovery, a fraud of a global recovery. It was more price illusion than it was anything real. And then you see German rates start to rise late 2021 and entering 2022. And the difference there is not fundamental. That's the central bank. That's the ECB getting in the way at the front end of the yield curve. And remember, the ECB deposit rate went from 0.5% negative to plus 4%. At the same time, Germany's 10-year went from 0.5% negative to only 3%, which said that the market was disagreeing with the central bank on rate hikes and wanted to be more like what we saw and see in China. So last year, the global bond rally starts as the market starts to anticipate central banks getting out of the way. And where do rates start to go? They start to move in the same direction as China's bonds, but the bond market in China was going much lower at the same time and continued to go lower to the end of this year. And so now we have lower rates in Germany as well as China, but with the Chinese going faster, even though they're already farther to the downside anyway. You think, okay, that's Germany. Germany's their close trade connection with China. Maybe Germany's just picking up on Chinese factors. Well, let's go to Canada. Canada, you see this pretty much the same thing. In fact, an even better correlation with Canadian government bond yields with China than Germany. They're near spot on between 2011 and 2021. So for an entire decade, you can clearly see there's a very close corresponding, especially synchronized in timing and degree. There were some notable exceptions. There's a small divergence again in 2018. While China's yields are going down in the early part of 2018, Canada's yields were going up until October, November in the landmine. And the difference there was the Bank of Canada raising rates, just like the Federal Reserve. We see the same thing to an even greater extent in 2022, just like in Germany. So 2022, Canadian yields rise pretty sharply while Chinese yields are going in the opposite direction. And eventually, after the Bank of Canada starts to get the hell out of the market's way, where are Canadian yields going? They're going down where Chinese yields are going down in the same direction, to not quite to the same extent, not yet anyway, to where China is. Finally, we'll look at U.S. Treasuries. Like Canada, we see pretty close synchronization up until 2018. 2017 and 2018, the Federal Reserve gets in the way with rate hikes. Same thing again in 2022, where Treasury yields surge ahead, but not nearly as far as the Federal Reserve raised its short-term benchmarks. But even so, once the Federal Reserve starts, it looks like the Fed is going to get out of the way, stop hiking rates, and maybe even cut them. Rates want to go down. They want to go in the direction of where China already is. So the question that we're asking here from China's perspective, are Chinese yields going to decouple from the rest of the world for the first time in quite a long time? And for what reason would they do so? We don't see anything like that. So do rates converge with China, or does China converge with Western central banks? Well, the evidence suggests that interest rates in the West want to go lower to where China is, rather than Chinese yields somehow being picked up and pulled up toward Western central banks and where their short-term rates are. It's quite the opposite. China's yields are going down further and faster. And in many respects, you could see the same thing happening, just in more volatile fashion, because of the variability in central banks and the market's ability to discern what central banks are going to do in the future. There's volatility in that process, but either way, yields have been moving lower since last year around the world. More likely that Western rates are going to converge with China than the other way around. And that's something we've seen before in U.S. dollar interest rate swap spreads. By the way, U.S. dollar interest rate swap spreads hit more record lows. At least they're a record low today before the close, or what would be a record low if it holds on. The 30-year swap spread is minus 86.9 basis points today, which would be a record low. That was after being minus 84.1 basis points on Friday. 10-year swap spread is at minus 52 basis points, which is just barely above its record low from November 4th. And as I've shown before, U.S. Treasury yields, therefore a lot of the global marketplace, follows interest rate swap spreads. Whenever we see Treasury yields diverge with swap spreads, they converge with swap spreads at some point in the future. And again, I'm not suggesting there's a mechanical relationship, but eventually once central banks, which are the reason for the divergences, get out of the way, the fundamentals take over. And without central bank interference in interest rate swaps, as well as in Chinese government bond yields, the fundamentals in both of those, that's where interest rates around the world are going to go when we don't have central bank interference. And so what you see is that, sure enough, U.S. dollar interest rate swap spreads, in particular the 30-year maturity, closely corresponds with Chinese government bond yields because they're both reacting to the same global factors. And because both of them are free from central bank interference, they can picture these global fundamentals. They can price these global fundamentals better than nominal yield curves and nominal government bond markets because they have to at least respect what central banks are doing, what central banks are likely to do, even if central bankers have no friggin' idea what they're going to do in the near term. So both of those segments, Chinese government bond yields and U.S. dollar interest rate swap spreads, are saying rates are going to go a lot lower. In many ways, they already have. And now with central banks cutting rates pretty aggressively and likely to accelerate their rate cutting schedule, even the Federal Reserve, no matter what it says in the short run, that means that already the entire interest rate marketplace is moving down to where the fundamentals already are. And the fundamentals keep getting further and further lower and further away from where nominal rates are today. So, are we going to see interest rate swaps and swap spreads converge with where central banks would like them to be? Are we going to see Chinese government bond yields suddenly turn around and surge higher? the chances are almost zero. The fundamentals that are priced in those make sense with all the data that we're getting. And the data that we're getting says downside of the supply shock, silent depression, cyclical factors, all of it. Rates are going to go down a lot farther and maybe a lot faster than they are now, except if you're in China where rates are going down fast and far already in near historic fashion. I mentioned China's woeful banks and something called money finance fiscal expansion that's already been mentioned in China. Went over both of those, the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.